Hello, my friend. Welcome to Charlie Retail Invest. Let's track the latest trend in US economy and share our recent investment in stock and bond markets. Today is Thursday, August 7th. In this episode, I want to share with you why the stock price of Berkshire Hathaway, owned by Warren Buffett, has been declining since early May of this year. I also want to share my thought on Berkshire Hathaway's future performance. I'll discuss what price would be a safe entry point for those who want to hold BRK.B stock for long term, considering buying into this multinational investment group. Additionally, Amazon stock price plummeted 8% in a single day after the release of its Q2 financial report, and AMD also continued its tradition of plummeting after the financial report, giving everyone the chance to get on board. I'll talk about these two excellent tech companies and their current fundamentals to see if it is worth of us to buy the dip and at what price we can be very safe to invest in AMD and Amazon. Well, let's first take a look at Berkshire Hathaway's financial performance in the second quarter of 2025. Overall, BRK.B's financial report is quite disappointing to investors. The company's revenue for the quarter was $92.5 billion, a slight decrease of 1.2% from $93.6 billion in the same period of last year. The net income was $12.37 billion, a significant 59% year-on-year decline. The decline in Berkshire Hathaway's net income was primarily due to the company's record-breaking divestment of its previously held stake in Kraft Heinz and the recording of a $5 billion pre-tax asset impairment loss. In addition, the company's operating profit in this quarter was $11.16 billion, down 3.8% from the $11.6 billion in the same period of last year. This decline was mainly due to the adverse impact of the insurance business due to claims from wildfires in the Los Angeles area in California earlier this spring. Berkshire Hathaway stock investments saw a net sales of $3 billion, making its 11th consecutive quarter in which sales exceeding purchases of the stocks. Buffett clearly didn't buy the dip in the US stock back in April of this year either, which was triggered by Trump's retaliatory tariffs. Therefore, Berkshire Hathaway stock holdings haven't generated any significant returns for the company compared to SP 500 index. Furthermore, although BRK.B stock price has fallen by over 10% from its all-time highs, the company still did not repurchase any shares in the second quarter. This marks the fourth consecutive quarter that Berkshire Hathaway has not repurchased its own stocks, indicating that management team still believes that the company's current market value is still quite expensive and not cheap at all. This also explains why BRK.B's stock price had been on a downward trend since May 3rd, when Buffett announced that he would step down as CEO of Berkshire Hathaway at the end of this year and be succeeded by Greg Abel. As of August 6, BRK.B stock price closed at $469 per share, down 13.5% from its high of $542 3 months ago. Furthermore, when looking at weekly and monthly charts, BRK's downward trend isn't over yet. We are likely to see BRK.B's price continue to move downwards over the next few weeks, potentially reaching a range below $430 per share. So, for investment friends like myself who adores Buffett, can we take the advantage of this correction and grasp the opportunity to actually buy BRK.B shares at a relatively low price and then preparing for holding them in the long run? Well, I believe that we can actually wait for a little bit longer because from a fundamental financial perspective, Berkshire Hathaway may face the dilemma of reporting below expectations throughout the entire fiscal year of 2025. We should know that in the past few years, Berkshire's financial revenue data has remained steadily upward trend. But in the first half of 2025, its financial performance has fallen short of expectations twice. Have you thought about the two programs that we did at the end of July when we talked about the medical insurance leader United Health Group and the well-known sports brand Lululemon? As representatives of traditional industries, their financial reports had been very strong in the past few years. However, this year they finally couldn't hold on. Their financial reports began to worsen and their stock prices had fallen by more than 50% in a single year, which is quite terrifying to be honest. In fact, aside from the booming AI-related tech companies and financial institutions like Robinhood and SoFi, the performance of most other traditional companies in 2025 will be similar to that during the 2008 financial crisis. A 30% decline on stock price would be considered quite good, and most traditional companies start with a 50% decline in stock price. Of course, Berkshire Hathaway, backed by Warren Buffett, still boasts a market capitalization exceeding $1 trillion. Furthermore, Buffett holds over $300 billion in short-term US Treasury bonds, ensuring a very healthy balance sheet. We certainly wouldn't see Berkshire stock's price plummeted by more than 25%. However, based on the current situation, Berkshire's EPS in 2025 will fall by 6.5% compared to last year. And by next year, which is 2026, its growth rate will also be very slow at only 5%, which is lower than the actual depreciation rate of the US dollar, which is at 7%. Besides the profits, Berkshire's overall revenue growth has also stagnated. In 2025 and 2026, revenue growth rates are expected to be at only 1.5% and 4.3% respectively, which is lower than the growth of Apple, which is the slowest growing tech giant. Therefore, we do not need to rush into buying BRK at the bottom, because at least within the next year or so, it will be very difficult for Berkshire's stock price to have the momentum to continue to move upward, and it is more likely to remain volatile or even fall slightly. Of course, we all know that when the new CEO Apple takes over at the end of this year, he will ultimately plan to use Berkshire's substantial cash reserves to acquire promising large and mid-cap companies. However, it will take at least several quarters for the integration of these acquisitions and for these investments to actually lead to accelerated EPS growth. Therefore, I plan to reassess Berkshire Hathaway's fundamentals and see if there's any significant change by December 2025 or in the first half of 2026. Till then, it will definitely not be too late to buy BRK.B. And if you are eager to become a Berkshire Hathaway shareholder or deeply admire Buffett's investment style, our AI model predicts that BRK.B will likely bottom out between $388 and $410 over the next 3 months. This also reflects the company's expected stock price between January 2024 and June 2024. And if you are interested, you should consider this buying the dip opportunity. And beyond its growth potential, investing in Berkshire Hathaway also offers a strong defensive advantage. If the US stock market experiences a panic sell-off due to some black swan event, investing in BRK.B can effectively hedge against the broader market risk. This is also the premium offered by Berkshire Hathaway as a company. Of course, as the stock god Buffett gets older, his management team function of the company will become weaker and weaker. And also Munger has passed away, so the halo that previous generations of great investors brought to Berkshire Hathaway will gradually dissipate. Let's wait and see whether this giant enterprise can achieve new glory under the leadership of baby boomer Abel, who was born in the 1960s. Okay, let's talk about Amazon's Q2 earnings report, the number one company in e-commerce and cloud computing. Its revenue figures are very impressive and its overall growth is encouraging. Amazon's total revenue in the second quarter reached $167.7 billion, a year-on-year increase of 13%, exceeding Wall Street expectations. Its net profit reached $18.2 billion, a year-on-year increase of more than 34%, which is also exceeding market expectations. Operating profit reached $19.2 billion, a significant increase of 30% year-over-year. However, despite Amazon's impressive financial report, its stock price plummeted by 8% in the following trading day, from $234 per share to around $210 per share. The main reason is that the company's core business, AWS, cloud computing, has a growth rate of only 17.5%, which is much lower compared to its competitors, Microsoft's Azure and Google's Google Cloud, whose cloud service growth rates are as high as 39% and 32% respectively. Of course, part of the reason that the AWS is much larger than Azure and Google Cloud, so its slower growth is understandable. However, investors are more concerned about whether AWS application in artificial intelligence will lag behind other companies' cloud services. I believe that it is a bit too early to determine that AWS prospects in AI is lagging behind Azure and Google Cloud just based on one quarter's growth data. And Amazon CEO Andy Jassy also emphasized during the earnings call that the company will increase investment in AI infrastructure and improving user experience. Amazon is aggressively expanding its data center network and spending heavily on developing its own AI chips and purchasing high-end chips from Nvidia. We may see that in the third quarter financial report, AWS growth rate will pick up again, which will be a very important driving force for Amazon's stock price. From a fundamental perspective, Amazon's EPS growth rate in 2025 and 2026 will remain at a very high level of 19% and 14% respectively, which is even higher than Microsoft's EPS growth rate. And its fundamentals are very solid. I believe that buying Amazon stock at $215 or lower is still a very good opportunity for long-term holders. Of course, if you are patient enough, you can wait for the US stock market's correction in August to buy Amazon shares at a cheaper price. Our AI investment system predicts a low entry point for Amazon shares in the coming quarter is likely between $190 to $200, which is over 10% cheaper than Amazon's current price of $223. We can certainly wait and buy the tip afterwards. Finally, let's talk about AMD, the second largest company in the chip field for 1,000 years. It has been following the pace of its big brother, Nvidia. In the new track of AI chips and data centers, everyone has very high expectations for AMD to perform. In the second quarter financial report released on August 5th, AMD's revenue reached a record high of $7.7 billion, a year-over-year increase of 32%, exceeding market expectations. Its data center revenue reached $3.2 billion, a 14% year-over-year increase, primarily driven by strong demand for ePYC servers. The client and gaming businesses also performed strongly, each with year-over-year growth exceeding 70%. AMD also raised its Q3 outlook, projecting revenue to rise to $8.7 billion and a gross profit margin of approximately 54%. Although the company had to set aside $800 million in inventory and related expenses due to the US government's export control on chips to China, which resulted in AMD's second quarter net profit being negative, the overall development direction is very good. However, after the release of its Q2 earnings report, AMD's stock price plummeted 7% from $178 to around $162. And 2 trading days later, AMD's stock price rebounded again, reaching over $170 on August 7th. The market is primarily concerned that the company's AI chip growth and GPU-related data center business are not growing as expected, potentially widening the gap between its status and Nvidia's leadership in GPU data center business. Charlie believes that AMD still lags far behind Nvidia in terms of software infrastructure directly related to GPUs. Furthermore, building related software services for AMD will certainly take longer time and incur greater costs. However, as soon as Lisa Su's management team remains committed to AI high-performance computing, there's a great chance that AMD, just like Nvidia, will achieve significant growth in AI computing and data center revenue over the next 2 to 3 years. In addition, from the perspective of the company's fundamentals, AMD's most difficult transition period from 2022 to 2023 has passed. In the following next 2 years, in 2025 and 2026, AMD's net earnings per share will remain at a very high growth rate of 18% and 52% respectively. Therefore, I will continue to hold my AMD shares. In the short term, if the stock price drops below $160, it will be a fairly good entry point to buy. Of course, as we've predicted in our last episode, the US stock market has room to continue its downward correction in August, so AMD's stock price may fluctuate during this period, allowing investors to obtain a cheaper entry price. Currently, our AI system predicts a low entry point for AMD stock price at $140 to $155 over the next 3 months. I recommend considering investing in AMD and holding on this great chip stock with significant growth potential. Now, next is the portfolio allocation generated by the AI investment system as of August 7th. With slight changes from previous allocations, we still recommend maintaining a 50% position in stocks or index ETFs. However, the system does recommend to increase the proportion of short-term treasury bonds from 20% to 25%. Furthermore, the position in gold ETFs has also been reduced from 20% to 15% because gold prices have risen significantly over the past week. So the system recommends taking profit off some gold position and transferring profits to short-term treasury bonds. The Bitcoin position remains unchanged at 10%. Our asset allocation can be described as being very defensive. The system has already been making early preparations to buy the dip after the US stock market fall in the near future. This is CRI Portfolio's holdings as of August 6, 2025. We sold some of our positions in gold ETF IAUM to take profits and shifted some funds to ultra-short treasury bond SGOV, thus increasing our cash position. Other stock positions remain unchanged. AMD, Google, and Eli Lilly remain the top 3 holdings in our portfolio. As of August 5th, 2025, the CRI portfolio has achieved a return of 13.3% this year, which is 5.43% higher than the SP 500's return of 7.9%. We hope our portfolio can continue its strong performance for the past few months. Of course, the figures shown here are for IRA accounts with more frequent short-term trading. If you are a conservative long-term investor, I strongly recommend considering CRI Investment's recommendation allocations for US stocks, gold, and Bitcoin. And that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy and follow our most recent trading activities, please consider subscribing to our channel, Charlie Retail Invest. Thank you so much for your time and support. I'll see you in the next video. Please take care.